What's going on, you guys? My name is Zach Hartley, and I spend a whole lot of time here on the YouTube platform, either uploading my own videos or watching other people's videos. And almost every single day on my homepage, I see a new video talking about the top 3 dividend stocks to buy now, or my favorite dividend stock, and here's the reasons why. And every time I click on one of those videos, I keep thinking to myself, this is probably not the right strategy for this guy, and I would never buy that stock, and I cringe a little bit inside. And so in this video, I want to break down for you a couple of different factors you should consider before getting into dividend investing, as well as the reasons that I don't dividend invest and the reasons that I don't make videos about the top 3 dividend stocks to buy now. So this video is going to be a little bit contrary to a lot of the opinions that you see here on the platform. But if you get any value, remember to click that like and subscribe button. And again, this is all just my opinion based on my situation. So when I think about dividends, there's 3 main reasons that I don't focus on dividends. The first reason is taxes, second reason is cash flow, and third reason is company selection. So let's dive in to all 3 of these individually. So number 1 here is taxes, and this is probably the largest factor. This factor alone probably could have influenced the decision, but it's really, really important here because when a company has money, they can either choose to invest that back into themselves, sort of like what Amazon does. They operate at a loss for like 20 years and now they're finally starting to make some money. Or they can keep that money, they can pay income tax on it, and then they can issue that money out to shareholders in the form of a dividend. Now, the problem that I have with dividends is that when I collect a dividend, I am forced to pay taxes on that. And so when I collect that dividend, I have to receive that as income, I have to report it as income, and I get taxed on that dividend income. And what I don't like about that is that instead of keeping my money in the market and invested in the company is in some cases paying tax on it. They're issuing it to me, and then I'm forced to pay tax on it as well. And in my scenario, I'm putting it back into the market. So it's kind of like paying taxes for absolutely no reason. I would have just rather have it invested. And so the number 1 reason here that I don't like dividends is because I don't need the dividend right now. And because of that, when I get issued a dividend, it is literally just forcing me to pay taxes, and that is the last thing that I want to do because it leaves less money for me and my family and the things that I want to spend my money on. Now, the second part of taxes here, and the even worse part of this whole thing, is that when you generate income from your investments, you have 3 different types of profit that you can make from those investments. The first one is interest income, and that is taxed at the highest rate. You basically have to add that onto your income and then you get taxed at your marginal rate. Now your dividend income is sort of that middle level where there's usually some benefits in there and it's not quite as high as your marginal tax rate. Now the best type of income that you can generate is capital gains tax because you only have to pay taxes on 50% of whatever your capital gains tax is. And when I say capital gains, I'm saying that if you buy Apple shares at 100 and you sell them at 200, you have $100 worth of capital gains tax there. And when you do your taxes on that, you only have to pay taxes on 50% of the gain. And so capital gains are taxed the most favorably for investors like myself. Dividends are sort of that middle bracket, and then interest income is the highest bracket there, or it's the least favorable with regards to a tax perspective. And so if I had a choice of how I wanted to generate my profits and generate my income, I would always choose capital gains to generate my income and profit because I'm going to pay less taxes on capital gains than I will if I pay on dividends. And so to summarize this point here, when a company issues me dividends, I, number 1, not only am forced to pay taxes on those dividends, but that is an investment that I made and I'm getting money back on it and I'm paying taxes at basically that middle bracket. It's not good enough to be capital gains and it's not bad enough to be interest income, but it's dividend income and it's sort of that middle level, which is worse than capital gains. And so there's not a huge set of advantages when it comes to bringing in dividends. The big advantage for most people is cash flow, and we're going to talk about that in 1 second. One thing that you do have to consider though is that here in Canada, depending on what country the company is based in and what type of account you have that investment in, it can heavily dictate the type of taxes that you pay. So I am generalizing here and I am mostly focusing on a standard margin account because usually people have maxed out their RRSP and TFSA, but it does definitely depend on the type of company, where they're located, and what type of account you have them in. But in general, dividends force you to pay taxes, and dividends come at a higher tax rate compared to capital gains. And so if I had the choice, I would always like to focus on capital gains. Now, like I said, the reason that a lot of people focus on dividends is for the cash flow. And if you're a 60-year-old or 70-year-old person that's in retirement, that's living off your investments, and you need money to pay rent and go to the grocery store, then dividends are like the greatest thing in the world for you. Keep your dividend portfolio. It's absolutely fantastic. This is the right solution for you. However, if you are a 20 to 35-year-old dude that is investing or says you're investing for the long term of 20 to 30 to 40 years from now, and you're focused on a dividend portfolio that's giving you cash flow right now, I usually don't think that's the right solution, because if you are investing already, it usually means that you already have a job or some type of income, and with your extra income, you're putting it into the market. And when you invest into dividend companies, you're focused on getting some of that money back out of the market, and when you do that, you have to pay taxes on it. And so if you have a 20 or 30 or 40 year time horizon, then that money that you are paying taxes on right now, that money that you are handing over to the government this year that you're giving over in the form of taxes, well, that money could have a very large impact on your overall return 20 or 30 years from now. And so I would much rather keep that money invested, not pay taxes on it, keep it in the company, and if I need to rebalance my portfolio, then I can pay a $5 or $10 commission rather than the full dividend tax on the income that I make for that year. It just doesn't make any sense. And so when I see young people, especially 20 to 35 years old, that say they're investing for the 20-year time horizon, but they're focusing on dividend stocks, to me it just doesn't make sense. And it sounds like you need the comfort of collecting that money to feel good about yourself, but the penalty for doing that is that you have to pay taxes on it every single year, and over the course of 20 years that's really going to add up. And so you're really penalizing yourself if you're buying dividend stocks just to feel good because you like that payment every month or every quarter. Now, the last factor that I want to talk about here is definitely the smallest factor. It's not a huge factor by any means, but it's definitely something to consider, and that is company selection, because not all companies pay dividends. In fact, if you looked at the NASDAQ 100 as an index and you said how many companies within that 100 company index pay a dividend, the number is only 20. And so if you only focus on dividends, you're eliminating about 80% of that index, for instance. Now, if you look at other indices like the S&P 500 or the Dow Jones, that number is much, much higher, but it does cut you off from a lot of high growth companies such as Shopify or Tesla or Drone Delivery Canada. Lots of different companies that I like to talk about that I think are exciting, that are developing new technologies and that are going to be at the forefront of tomorrow. You just won't have access to them because most of them don't pay a dividend. So here's my strategy, here's what I like to focus on, and here's how I think about things. I have a separate account that is used for day trading and swing trading and short-term investing, and then I have my basically TFSA and RRSP and long-term margin account that is focused on and dedicated to long-term investing with a 20 to 30 to 40 year time horizon. And in those accounts, I am looking for capital gains and I am looking for long-term growth. I'm investing in great companies with high growth, and I am investing in them for the long term. The reason I am doing that is because I don't need that money right away. I have enough cash flow right now, and I would like to see appreciation as much as possible in those accounts, because capital gains is taxed the most favorably, which means I'm going to be left with the most money left over in my retirement. I can also take advantage of my tax-free savings account, which will allow me to invest about $6,000 per year and never pay any capital gains on the investments in that account, which is really, really nice. I also do use my RRSP account, but I use it for real estate. I'm allowed to withdraw $35,000 for it for a first-time home purchase every 4 years, and so that is a really, really nice benefit of the RRSP. So I mostly use that account for real estate. If you are looking for dividends though, the RRSP is probably the most favorable dividend account. Now, if you're interested in learning a little bit more about how to understand the market and buy in and out of these companies at the right time, then you should definitely consider signing up for my Stock Market Fundamentals course. It is completely free and it's hosted on Skillshare. That's where you can get access to the entire 10-hour course that will walk you through step by step everything you need to know to get started in the market. There's over 7,000 students that have already gone through the course, and there's over 300 reviews for you to take a read through, and I promise you it'll be the best free resource that you can find online. Sign up with the link down below. You get a 2-week free trial, cancel your subscription before the 2 weeks is up, and you just got access to the entire course completely free. Now, if you're interested in learning a little bit more about how I invest, definitely check out my channel. I also run a Discord chat where I post all of my trades and all of my analysis. So I've got a ton of resources. Everything is linked down in the description to this video, and I'd love to share them with you. I will see you guys in the next video though. Good luck trading, good luck investing, and we'll talk to you soon.